So we'll now start with reading number 11 of the level 3 curriculum that will tell us about taxes and private wealth management in a global context. So we'll start by understanding the global taxation regimes, the types of taxes, namely accrual, capital gains and wealth tax. Understand what happens when there are multiple taxes on an income. Understand tax advantaged accounts, the concept of risk reduction with taxes, the tax effects of various trading behavior, tax loss harvesting, and wind up with understanding taxes and how they affect the mean variance optimization. Now, taxes can be levied on income. So there is an individual tax rate and there is a corporate tax rate that various governments across the world notify. Taxes can be on wealth. So these are based on the value of assets held or when there is a transfer of wealth from one party to another. Taxes can even be on consumption. For example, sales tax that is simply calculated as a percentage of the selling price, or as value added tax, which is paid at each intermediate production step according to the value added at each step. Both the sales tax and VAT are normally eventually borne by the consumer and included in the final price of the goods and services. Total taxes is the total dollar amount of tax that the individual has to pay. The marginal tax rate is the rate at which incremental income will be taxed. So any new income earned will be taxed at the marginal tax rate, and the average tax rate is calculated as the total taxes paid divided by the total taxable income. So assuming an ordinary income of $220,000 and tax rates that are given in the table, calculate the total taxes, the marginal tax and the average tax rate. So if the income is $220,000, then in the investor's country, up to $10,000, the tax rate is 10%. So any income generated up to an annual income of 10,000 will be taxed at 10%. Incremental income over and above 10,000 up till a level of 25,000 will be taxed at 15%. So the total tax at this stage will be 15% of the incremental amount plus $1,000 of tax that was from the previous bracket. Between or till 75,000, similarly, you will have to pay 3250 from the earlier two brackets plus 20% of whatever income falls in this bracket. Our investor actually lies in the second last bracket, that is, he has an income of $220,000. So $70,000 that is over and above 150 will be taxed at a rate of 30% plus $32,000 of taxes that he'll have to pay from all the previous brackets will give us his total tax. So total tax will be equal to 70,000 into 30%, that is 21,000 plus 32,000, that is equal to $53,000. The marginal tax rate will be 30%, that's what incremental income will be taxed at, and the total taxes we have already calculated. The average tax rate can be calculated as the total taxes paid divided by the total taxable income of $220,000. Now, generally the global tax regimes are in the way we discussed, that is, they are progressive. As the income increases, the tax rate also increases. Various regimes otherwise are possible and different regulations and different countries have them. So in a common progressive regime, the tax structure is progressive like we discussed, and there is a favorable treatment for interest, dividend and capital gains. So income from these sources is normally taxed at a lower rate than salary or regular income. Heavy dividend tax is also progressive, and does not give the benefit to dividend income. So dividend income is taxed at the same rate. Similarly, heavy capital gains tax will not give any benefit to capital gains. Heavy interest tax regime will not give any benefit to interest income. In a light capital gain tax, no benefit is given to interest income or dividend income. Only capital gains are taxed at a lower rate. Similarly, in a flat and light structure, the tax rates are flat. So regardless of your income, you have to pay a fixed percentage as tax. And there is a favorable treatment for dividend income, capital gains and interest. In a flat and heavy structure, the rate is flat and there is normally no favorable treatment to capital gains and dividend income. However, some favorable treatment exists for interest income. Again, not important, you don't need to remember the slide. The first category of taxes that we'll study in detail refers to accrual taxes. So remember, accrual taxes are paid on accrued income or reported income. Normally these taxes are paid periodically, that is annually. If R represents the annual investment return, that is income plus capital gains, calculate the future value interest factor after investment income tax. So this is the calculation that we are going to do very extensively and many times in this review. The future value investment factor is that if you invested $1 today, what would be the value of this $1 at the end of the investment period? So if R was the annual investment return, then $1 today would earn a rate of R at the end of 1 year and would grow by 1 plus R. However, this R will not fully come back to us. This R will be taxed at the rate of the accrual tax rate. So R would actually become R into 1 minus the accrual tax rate, and this is what the value of our $1 be after 1 year. This entire amount will be invested for the next year and again will generate a return of R. However, this entire R won't come because in the next year as well, on the return we will have to pay an accrual tax rate, so it would be into 1 minus the accrual tax rate. The same phenomena will repeat itself till the number of years that we have been invested. So the future value investment factor after n years would become 1 plus R into 1 minus T accrual tax or T investment tax to the power n. If $5,000 is invested for 10 years and earns a before tax return of 15%, assuming the accrual tax rate is 35%, calculate the after tax value of the account in 10 years. So we started with 5,000. At the end of every year, we get a 15% return, of which 35% is taken away in the form of taxes. If we raise this to the power 10, this would be the future value investment factor. That is $12,676. Now, a very important calculation that needs to be done is the calculation of the tax drag. The tax drag is calculated by comparing the future value with taxes with the future value assuming there were no taxes. So assuming there were no accrual taxes, the 5,000 would have simply accrued at the rate of 15%, or the value would have been 5,000 into 1.15 to the power 10 after 10 years. That is about $20,228. So without any taxes, our profit would have been equal to 2227.8 minus 5,000. And with taxes, our profit actually has been 12,676.97 minus 5,000 over a period of 10 years. The tax drag is calculated as the difference of the gain without any taxes and the gain after taxes. So the tax drag is the gain lost to taxes, that is 15227 minus 7676, that comes out to be $7,550, or this is the tax drag in dollar terms. Tax drag can also be calculated in percentage terms, which will be this same amount divided by the gain with no taxes. So remember, tax drag as a percentage is the tax drag in dollar terms divided by the gain with no taxes. Don't divide it by the future value, or don't divide it by the future value of no taxes. It is the tax drag dollar amount divided by the gain with no taxes. So the percentage tax drag is 50%, or you can say 50% of the profit has been lost to taxes. The tax drag in dollar terms is 7,550. Now with regards to accrual taxes, please remember that increasing the investment horizon will increase the tax drag both in dollar terms as well as in percentage terms. Let's verify with an example. So if instead of 10 years we had the money invested for 20 years, then the gain without any taxes would have come out to be about $77,000. That is 81832 minus 5,000. The future value with taxes comes out to be 1 plus 0.15 into 0.65 to the power 20 into 5,000, or the gain after taxes would be this minus 5,000, that is only equal to $27,000. So the tax drag will again be the difference of the gain without taxes minus the gain with taxes, that is, it comes out to be about $50,000. So we see that in dollar terms this amount has moved up from $7,550 that we calculated in the previous example when there were only 10 years of investment. So not only does the amount go up in dollar terms, as is quite logical, the tax drag also goes up in percentage terms. So if we calculate the tax drag now as a percentage of the gain without any taxes, this number would be 65% or 64.68%, up from the 49% that we had calculated earlier. Remember, increasing investment horizon with accrual taxes increases the tax drag in dollar terms as well as percentage terms. The reason is that this tax rate is getting compounded, because this lower income is getting compounded and that income is again further getting lowered. So without any taxes, our income would have accrued unabated, and now we are putting a tax not just once, we are putting a tax every year. So every year the income is getting reduced, and then future return also is now coming only on that lower income. So the more the compounding, the more amplified will be the impact. Remember, if the tax rate is getting compounded, then both in percentage terms as well as in dollar terms the tax drag will increase as time horizon increases. If the tax rate is not getting compounded, as we'll see in some future examples, then the dollar tax drag will be higher, but the percentage tax drag will remain constant. Similarly, increasing return on investment will increase the tax drag both in dollar terms as well as in percentage terms. So instead of 15%, if you assume that the investment will make a 20% return over the next 10 years, then the future value at the end of 10 years would be $31,000 without any taxes, and the future value after taxes would come out to be about $75,000. That is a 20% return, 35% goes to taxes, compounding for 10 years. Again, we can verify that the tax drag in dollar terms will come out to be $14,000, much higher than the 7,550 that we had compounded or that we had calculated with a 15% return, and the tax drag in percentage terms also goes up to 54% as against the 49% that we had calculated earlier. Again, the returns are getting compounded, so the impact will get magnified both in dollar terms as well as in percentage terms. To summarize, with accrual taxes, the tax drag as a percentage will be higher than the tax rate. The tax rate was 35%. The tax rates or the tax drag in all cases was higher than 35%. It ranged between 49% to 64% in the examples we saw. As the investment horizon increases, tax drag in both dollar and percentage terms increases. As the investment return increases, again, tax drag in both dollar and percentage terms increases. With deferred capital gains tax, taxes are paid when the asset is sold and the capital gains are realized. So whatever returns we may be earning in the years will not be taxed until the return is realized. So we're not paying on accrual taxes, we are paying when the capital gains is realized. This regime is referred to as the deferred capital gains tax. Again, if R represents the annual unrealized capital gains, calculate the future value interest factor after deferred capital gains tax, assuming returns are realized after n years. TCG represents the capital gains tax rate. So future value investment factor is the value of $1 at the end of n years, that is at the end of the investment horizon. So we are generating a return R. However, this return is not realized. It's only a mark to market gain. This R will not be taxed and will keep compounding at the rate of R for the next n years, because the return is again reinvested and earns us a return of R. So $1 would become 1 plus R to the power n after n years. Now, when we realize the gain, we will have to pay a tax on the gain. So our gain would be 1 into 1 plus R to the power n minus 1, because $1 was our original investment, we won't pay tax on that. This is our gain, and this entire gain will get reduced to the extent of the tax rate. So the tax calculation would be equal to 1 into 1 plus R to the power n minus 1 into TCG, or our net value would be this entire value minus this tax amount. So you can verify that this would come out to be 1 into 1 plus R to the power n into 1 minus the capital gains tax plus TCG. Please verify that this amount will come out to be 1 into 1 plus R to the power n will come common. This will be 1 minus TCG. TCG multiplied by 1 will remain TCG, minus and minus will become plus. So 1 plus R to the power n minus 1 plus R to the power n into TCG plus TCG is what this will become. 1 plus R to the power n can come out common. So this will be 1 minus TCG plus TCG. Another way to think of it is that if we tax the entire 1 plus R to the power n, then the value would become into 1 minus the tax. However, this would be incorrect because the original $1 we were not supposed to tax. So we've overtaxed to that extent. Hence, that is the amount that we add back, that is plus TCG. This is the additional tax that we have deducted. If we tax this entire amount, that is, we also tax the $1. $5,000 is invested for 10 years and earns a pre-tax return of 15%. Assuming a capital gains tax of 35%, calculate the after-tax value of the account in 10 years. So it would be 5000 into 1 plus 0.15 to the power 10. This will not be taxed for 10 years. When we realize the investment, we will pay a value of 65%. However, this 5000 doesn't have to be taxed. So in this manner, we are also taxing the 5000. So we will add back the additional tax that we have deducted on 5000. So this comes out to be $15,000. Once again, we will calculate the cash drag both in dollar terms as well as the percentage. Please note that the tax deferral has helped because the terminal value is greater than that from the accrual taxes. Even in accrual taxes, the return was 15%, but this 35% was being levied every year. So the tax deferral has helped as the future value is now $15,000 as against $12,700 in the case of accrual taxes. Tax drag would be the gain without taxes minus the gain with taxes. So it will be 20,000 minus 5,000 minus 15,000 minus 5,000. This 5,000 will get cancelled. Hence we can simply subtract the two future values divided by the gain without any taxes. So the tax drag in dollar terms would simply be this difference, and the tax drag in percentage term can be calculated as depicted. In dollar terms, it comes out to be $5,329 approximately, and in percentage term, the tax drag comes out to be 35%. Please note, the tax drag is simply the tax rate because it's not getting compounded or altered. So it's just the rate that we apply at the end. So this is the percentage by which our profits will come down. So remember, as investment horizon increases, the tax drag as a percentage is unchanged. It will still be equal to the tax rate. As the return increases, again the tax drag as a percentage remains unchanged because those factors don't impact. It will still be the tax rate. As the investment horizon increases, the value of the tax deferral will go up because the accrual taxes will become even more disturbing to the accrual tax regime. Similarly, as the investment return increases, the value of the tax deferral, that is the difference between the returns with capital gains tax, that is deferred capital gain tax, and the accrual taxes will further go up. Now in the previous example, we assumed that the $5,000 that we had originally invested came from after tax money, or the tax on that $5,000 had already been paid, hence we added back the TCG because we didn't want to double tax the original investment. A lot of times it's possible that even on our original investment we haven't paid the entire tax. In such a case, we will not add back the entire TCG. We will have to pay some tax when the investment is finally realized. So cost basis is defined as the original purchase price of the investment, which may differ from the current value. So in a previous example, the current value was $5,000 which gets invested into a particular asset. However, this $5,000 also had a cost basis of lower, let's say $3,000. Hence, when we eventually realize all gains, we will pay taxes as described earlier. Plus, we would also be required to pay tax on this $2,000 that we haven't hitherto paid. Lower cost basis increases the realized capital gains when the asset is sold. If B is the ratio of the cost of asset to the current market value, calculate the new future value of or future value investment factor. So B is defined as 3,000 upon 5,000. That is the cost divided by the current value or the value that has been invested. So the future value investment factor can be calculated again. If we invested $1, then the $1 would grow at the rate of 1 plus r to the power n, and we would have to pay a capital gains tax of TCG on it. However, instead of adding 1 into TCG, we would only add back B into TCG. B will always be less than or equal to 1. At best, the cost basis will be the same as the current value. At worst, of this $1, we would have paid nothing as tax, or B would be 0. So there would be nothing that will be added back because the entire amount has to be taxed. If B is 0.5, which means 0.5 out of this $1 has already been taxed, but 0.5 has to be further taxed. So 0.5 into TCG would be added back. You could do a more detailed calculation and again verify this. So 1 into 1 plus r to the power n is the final value of the investment. From this, we need to subtract the capital gains tax. Capital gains tax, however, will now not be 1 plus r to the power n minus 1. The gains are 1 plus r to the power n minus b. That is the cost basis, which may be lower than the current value. This multiplied by the capital gains tax is the tax amount, and this is the final value of the investment. We can again verify that this will come out to be 1 plus r to the power n into 1 minus TCG plus b into TCG. $5,000 is invested for 10 years at a return of 15%. Assuming a capital gains tax of 35% and a cost basis of 3,500, calculate the after tax value of the account in 10 years. So many ways of doing it. We can first calculate B, that will be 3,500 divided by 5,000, and then apply it in this formula, that is 5,000 multiplied by this amount. Or you could do it directly, that is 5,000 into 1 plus 0.15 to the power 10 into 1 minus 0.35 plus not 5,000 into TCG, only 3,500 into TCG, that is 0.35. So the entire 5,000 doesn't have to be not taxed. Only 3,500 of this has to be not taxed. 1,500 has to be taxed. So to correspond to the 3,500, we will add back, but not corresponding to the entire 5,000. Please verify the answer. Wealth taxes are applied annually on the total value of the assets held. So depending on various countries, geographies, a 1% or a 2% rate may simply be applied on your entire wealth, regardless of the income. So if R is the annual return and TW is the rate of wealth tax, calculate the future value investment factor after wealth taxes. So at the end of the first year, our $1 would become 1 into 1 plus R, and my entire wealth now, not just the income, is being taxed at TW or at the wealth tax rate. So this will be the value of the assets at the end of year 1. Next year, these entire assets will be invested for one more year and will generate a rate of return of R. And whatever is this entire value will again be taxed at the rate of TW. So the entire wealth will be taxed at 1% or whatever is the rate of the wealth tax. This phenomena will keep repeating for the next 10 years or n years. So the future value investment factor would become 1 plus R to the power n into 1 minus the wealth tax rate to the power n. So assume $5,000 is invested for 10 years at a return of 15%. Assuming the account is subject only to a wealth-based tax of 1%. Calculate the after-tax value of the account in 10 years. So the value would be 5,000 into 1 plus 0.5 into 1 minus 0.01 raised to the power 10. Please verify this will approximately come out to be $18,300. And just like we did it for capital gains tax, we can compute the tax drag as the future value without any taxes minus the future value with wealth taxes, or the gain without any taxes minus the gain with wealth taxes. That will come out to be $2,000. Tax drag as a percentage again can be calculated, comes out to be 12.7%. Please tell me, what do you think will happen in this case if the investment horizon goes up or if the return on the investment goes up? Now please note, if the investment horizon goes up, the tax drag both in dollar terms as well as in percentage terms will go up, for the reason that the tax is getting compounded, or the tax rate is getting compounded. However, if the return on investment goes up, then again the tax drag in dollar terms will go up. However, tax drag as a percentage will remain constant because the tax rate is not being multiplied by this return directly. So if the account is held for 20 years, you can verify that the tax drag both in dollar terms goes up from $2,000 to $15,000, and even in percentage terms goes up from 12.7% to 19.39%. If the investment return is 20%, then again the tax drag in dollar terms will go up to $3,000. However, the tax drag in percentage terms will become 11.4%. In fact, the tax drag in percentage terms will come down because the returns are higher. So my apologies earlier, the tax drag as a percentage doesn't remain same. It actually comes down because the return becomes a bigger portion, hence your denominator increases. So because the denominator increases, the tax drag as a percentage comes down. So for wealth-based taxes, tax drag as a percentage will be greater than the tax rate because of the compounding. So 1% was the tax rate. Tax drag as a percentage will be higher. It was 12% to 11% to 19%. As the investment horizon increases, both the tax drag in percentage terms and in dollar terms will increase. As the investment return increases, the tax drag in dollar terms increases. However, the tax drag in percentage terms decreases. The denominator in the calculation, that is the tax drag in dollar terms divided by the gain without any taxes. So even though tax drag in dollar terms is increasing, this gain is increasing by a much bigger amount because this wealth tax is only 1%, whereas the increases in return is happening from 15% to 20%. So the increase in this denominator is higher than the dollar increase in the tax rate, hence the percentage still goes down. Make sure you remember this point a little, guys. Every time in the exam you won't have the time to verify it yourself, so in case a qualitative question comes, you will be able to quickly answer it. A lot of times multiple taxes are levied on the income. So PI is the proportion of the total return from interest income, PD is the proportion of the total return from dividends, PCG is the proportion from realized capital gains. So an account is worth $70,000 at the beginning of the year and $85,000 at the end of the year. Assume no contributions or withdrawals happened at the account, so everything was returned. During the year, dividends of $3,000 and interest of $200 were received and reinvested into the portfolio. There was also a $2,500 realized capital gain, the proceeds from which were also reinvested into the portfolio. Calculate the proportion of the total return that can be attributed to interest, dividends, realized capital gains and deferred capital gains. The proportion from interest income would be $200 out of a total income of $15,000, 70,000 becoming 15,000, so will be 200 upon 15,000, that is 1.33%. The proportion from dividends would be equal to 3,000 divided by 15,000, that is equal to 20%. The proportion from realized capital gains would be equal to 2,500 divided by 15,000, that is 16.66%. And the proportion from unrealized capital gains, or simply capital gains, would be the difference, that is 15,000 minus 200 plus 3,000 plus 2,500, which comes out to be $9,300, or the proportion from unrealized capital gains would be 9,300 upon 15,000, that is recall that the before tax return on the account was 21%, that is $15,000 on a base of 70,000. Assuming tax rates on interest, dividends and capital gains of 20% on interest, 15% on dividends and 12% on capital gains respectively, calculate the after realized tax return, or the return after realized taxes and the account balance after payment of taxes. The realized taxes can be calculated as 200 into 20% plus 3,000 into 15% and 2,500 into 12%. The total return was 15,000. So 15,000 minus the realized taxes would give us the return after realized tax as equal to $14,210. Please verify that the total realized taxes will come out to be $790. The realized tax rate hence can be calculated as 790 divided by 15,000, that is approximately equal to 5.27%. Please verify that the realized tax rate and the return after realized taxes could have also been calculated from the income proportions that we calculated earlier. So the proportion of interest income was 1.33% multiplied by the tax rate of 20%. The proportion of dividends was 20% multiplied by a tax rate of 15%, plus the proportion of realized capital gains was 16.67% into the tax rate on realized capital gains, that is 12%, will also give us an effective tax rate or a realized tax rate equal to 5.27%. And please further verify that the return after realized tax, that is $14,210, could be calculated as 15,000 into 1 minus the realized tax rate, that is 0.0527. Or in other words, the return after realized taxes, only realized taxes, is equal to the total return, that is 21%, into 1 minus the realized tax rate. So the 21% return has actually become 20.3%, that is 21 into 1 minus 0.0527. Now let's try to see what we are going to do about taxing the unrealized capital gains. Whenever realized, we will have to pay a tax rate of TCG, that is the capital gains tax, on those unrealized gains as well. So the tax on the unrealized gains, the dollar amount, can be calculated as the unrealized gains multiplied by the tax rate on the unrealized gains. The unrealized gains can be calculated as the total return into 1 minus the proportion of the return from interest income minus the proportion of the return from realized capital gains minus the proportion of the return from dividend. Whatever is the remaining amount of the return has to be taxed at the rate of capital gains whenever it is. The return after realized tax can be calculated as 1 minus the realized tax rate as we calculated previously. This was the return after realized tax. Now let's assume, for example, that this quantity on the left came out to be $1,000 and the effective, rather the capital gains tax rate was 30%. Hence, the remaining capital gains tax would be an actual amount of $300. So this is the amount that has to be paid, calculated on the unrealized gain. Let's assume in the same example that the return after realized taxes, this return after realized taxes comes out to be $500. Then the effective capital gains tax is calculated as the percentage of return after realized taxes that will be needed to pay the unrealized capital gains taxes. The unrealized capital gains tax is $300. If the return after realized tax is 500, then TECG is calculated as that number that multiplied with the return after realized tax becomes equal to the unrealized capital gains tax, that is in this case equal to 300. Or the TECG in our example will be calculated as 300 divided by 500, that is equal to 60%. More generally speaking, TECG is that percentage of the return after realized taxes that equals to the unrealized capital gains tax, or TECG into the return after realized taxes, that will be equal to R into 1 minus the realized tax rate. The realized tax rate is PI into TI minus PD into the dividend tax rate minus the proportion from realized capital gains into the capital gains tax. So TCG, ECG is that rate that has to be multiplied with the return after realized taxes. This is nothing but the same formula that we derived earlier for return after realized taxes. That equals the unrealized capital gains tax. The unrealized capital gains tax is equal to the TCG, that is the capital gains tax, multiplied by the unrealized capital gains. Unrealized capital gains are simply equal to the total return into 1 minus the proportion from interest minus the proportion from dividend minus the proportion from capital gains. R will get cancelled and TECG, that is the effective capital gains tax, can be written as the capital gains tax into 1 minus PI minus PD minus PCG upon 1 minus PI into TI minus PD into TD minus PCG into TCG. Please note, the curriculum doesn't give the proof like we have derived. The curriculum simply gives you, and what you're required to know is simply the formula of the effective capital gains tax, that is TCG into 1 minus PI minus PD minus PCG upon 1 minus the realized tax rate. Now, what the effective capital gains calculation helps us do is that instead of applying a capital gains tax on the unrealized income, we can rather apply the effective capital gains tax on the return after realized income, because both will give the same amount, or both will give us $300. That is how we have calculated. The unrealized gain multiplied by 30% and the return after realized tax multiplied by 60%. That's how we derive the ECG. That is, this is the number that forces the multiplication with the return after realized tax to be equal to the unrealized taxes. This helps us get around the complication of the unrealized capital gains tax that have to be accounted for in the future. Please note that in a return scenario like this, where some part of the income is realized and some part of the income is unrealized, so a part of the income has to be taxed right away and a part of the income will be taxed in the future. If we simply depend on our TCG, it will be a much more complicated calculation in the end to differentiate the realized gains from the unrealized gains. So what we rather do is that we take help of the TECG and try to calculate the future value investment factor with multiple taxes. So calculate the future value investment factor assuming multiple taxes for an investment with a cost basis B. So please pay attention. Let's assume we had an investment of $1. On this $1, a part of the income was taxed and a part of the return was not taxed. What this value will be at the end of the year can be calculated as 1 minus the return after realized taxes. The return after realized taxes in the previous example came out to be 20.3%, please recall. Rather, 1 plus the return on after realized taxes. So on this $1, we are generating a return of R, for instance 21%. However, the 21% is not entirely coming to us. What is coming is only 20.3%, and this also includes some unrealized capital gains on which we haven't yet paid taxes. However, those taxes will be paid later. So right now at the end of the first year, we will have a total value equal to 1 plus 0.203 or 1 plus 20.3%. That is the return after realized taxes. If these income proportions continue, then every year we will have a return of 21%, of which a part will be taken away in taxes, and what will be left with is 20.3%, or this 1 plus R after realized taxes will continue for the next n years when we realize our investment. Now when we realize our investment, we also have to pay tax on all that unrealized income that has been accumulated in this 20.3%. So in this 20.3%, there is a lot of unrealized capital gains on which we haven't paid a tax. Now, we cannot now simply do 1 minus TCG, because this is not all unrealized income or unrealized capital gains. Hence, we calculated the value TECG, or the effective capital gains that can be applied to return after realized tax. We proved in the previous slide that rather than multiplying the unrealized income into TCG, it is the same thing as multiplying the return after realized taxes into TECG. So now, to calculate the capital gains liability or the tax liability, we will multiply this by 1 minus TECG. However, by multiplying with TECG, what we are doing is we are also taxing this $1 of our original investment if we simply multiply with 1 minus TECG. So we will add back our TECG entirely. Even though there is a cost basis given, we will add back the TECG directly, because the difference of 1 minus the cost basis has to be taxed at the entire capital gains tax rate, not just the effective rate. So, and we'll multiply this separately with TCG. So this workaround we derived in the previous slide just to ease things for ourselves. But the problem now is, now you can't just add B into TECG, because this 1 minus B has to be taxed at the entire capital gains tax rate. So we'll add TECG and we'll subtract the basis or the tax that has to be paid on our original investment and the tax that we haven't paid. So into 1 minus B into TCG. So please verify. This will be the future value investment factor, or this will be the value of $1 at the end of n years when the income has some realized component and some unrealized component. In our previous example, the return after realized taxes was 20.3%. Assuming that the return proportions continue for 5 years and that the basis is equal to $50,000, calculate the effective capital gains tax rate and the balance of account in 5 years after the payment of all taxes. First, let's calculate the effective capital gains tax. So instead of multiplying the unrealized income with the capital gains tax, we can multiply the return after realized taxes by the effective capital gains tax. So the effective capital gains tax will come out to be TCG into 1 minus PI minus PD, proportion from dividend minus the proportion from capital gains, upon 1 minus the realized tax rate. The realized tax rate is PI into TI plus PD into TD plus PCG into TCG. So the capital gains tax rate is given to be 12%. The numerator is the proportion of income from unrealized capital gains, which we calculated in the previous example, in the previous slide, as 62%. So this into 0.62 upon 1 minus the realized tax rate, which we've derived as 5.27%. So this minus 0.0527, the effective capital gains tax will come out to be 7.85%. So what we're saying is, instead of applying 12% on this 62%, even if you apply 7.85% on this 92%, or rather this 96%, that is the return after realized taxes, you'll get the same answer. So whether you do 12% into 0.62 or you do 7.85% into 94.7%, you will get the same answer. So the TECG comes out to be 7.85%. The value of our original investment, please recall, was $70,000, on which we earned a 21% return, that is $15,000. So the effective capital gains tax is 7.85, and the balance in 5 years after the payment of all taxes will be 1 plus the return after realized taxes, that is 0.2030 to the power 5 into 1 minus the effective capital gains tax, that is 0.0785 plus 0.0785 minus 1 minus the cost basis. Please note the cost basis will have to be calculated. It will be 50,000 divided by 70,000. That is what proportion of our $1 of income has not yet been, rather has already been taxed. So cost basis is what has already been taxed. Remaining is what needs to be taxed. This will be 0.714. So minus 1 minus 0.714 into the capital gains tax of 12%. $70,000 was the value of our initial investment. So 70,000 multiplied by this entire factor will give us the final answer as 165,618 approximately. So an important question. You don't need to remember the derivation and the proof. I just did it for better understanding. You do have to remember the formula for the effective capital gains tax. So we'll continue our discussion on tax rates and estate planning in the coming session. Thanks a lot and see you next time.